Welcome to the Deep Dive, your shortcut to being truly well-informed. Today, we're digging into Foundry Bancorp's second quarter 2025 earnings call.
Yeah, there's quite a bit to unpack here.
Absolutely. Our mission today is to break down those results, look at the strategy management laid out, and figure out what it all means for Foundry. They're in this big transformation phase, right? In a tough market.
Exactly. And the core tension seems to be, can they actually pull off this shift? They want to move from playing defense to offense, becoming more commercial focused.
But the market seems, well, a bit hesitant, maybe, about how quickly they can get back to consistent profits.
That's the feeling. You look at the quarter and operationally, things are definitely improving. Progress is there. But the market's reaction was, let's say, lukewarm. It's like investors see the steps but are waiting for the proof in the pudding, you know? Consistent black ink on the bottom line.
Right. Show us the money, basically. Okay, let's jump into the headline numbers then, because there are some interesting points. They reported a net loss, but it narrowed to $2 million for Q2.
Which is an improvement from Q1 and from last year.
Definitely moving in the right direction. And the GAAP EPS, that came in at negative 10 cents.
And importantly, that actually beat the street's estimates. Analysts were expecting maybe negative 11 or 12 cents.
So a slight beat there, which is always good to see.
Right.
But the number that really caught my eye was the net interest margin, the IN.
Ah, yes, the IN. Crucial for any bank.
It climbed 12 basis points compared to the last quarter, now sitting at 2.28%.
And that's not just a one-off blip.
Exactly. It's the third quarter in a row they've managed to improve the NIM. What does that signal to you, that consistency?
It signals real execution. NIM is the core profitability engine, the spread between what they earn on loans and pay on deposits. Seeing it go up for 3 straight quarters suggests they're actively managing both sides of the balance sheet effectively. It's discipline.
Okay, and beyond the margin, what about the balance sheet itself? Growth there, too.
Solid growth. Loans were up about $47 million, hitting $1.67 billion. And deposits also grew by roughly $29 million, reaching $1.42 billion.
And wasn't there something specific about those deposits?
Yes, and this is key. Most of that growth, about $25 million, came from core deposits.
Okay, remind us why core deposits are so important.
They're the gold standard for bank funding. Think checking accounts, savings, local business accounts. They're usually less sensitive to interest rate hikes and tend to stick around longer than, say, brokered CDs.
So more stable, probably lower cost funding.
Exactly. Growing core deposits signals deeper customer relationships, which is vital, especially in a competitive area like New Jersey. It helps keep funding costs down over the long run.
Got it. And while we're on stability, how did asset quality look? Any red flags?
Actually, quite the opposite. Asset quality looked really solid. Non-performing loans, NPLs, were very low, just 0.38% of total loans.
Well, that is low. Only about $6.3 million.
Yeah, it suggests their underwriting standards are holding up well. Good credit discipline.
So connecting the dots, narrower loss, beating EPS estimates, improving NM for 3 quarters, solid loan and core deposit growth, clean asset quality. The operational picture looks pretty good.
It does. The trajectory is positive. The loss is shrinking sequentially better than Q1 25, better than Q2 24. It feels like they are turning a corner, operationally speaking.
So this isn't just luck or market conditions. Management is actively driving this.
That's the impression. They seem quite satisfied, highlighting that NIM improvement and also how they're shifting the loan book towards things that earn more. The whole narrative is changing. It's less about just holding the line on funding and credit.
More about going on offense.
Precisely. Emphasizing higher yielding assets, keeping a tight lid on costs. Their stated goal is to become a more commercially focused bank, and they keep pointing to their strong capital and liquidity as the foundation for this shift.
It sounds like a clear plan. Let's dig into that NIM expansion a bit more.
Yeah.
12 basis points QOQ is significant. How did they manage that? What were the main drivers?
It was really a two-pronged success. They managed to increase what they earned on assets and decrease what they paid on liabilities. Both levers worked.
Okay, break that down.
Sure. Interest income, what they collect from loans, mainly went up by over $700,000, about 3.2%, hitting $23.4 million. That was mostly driven by loan growth.
Earning more. And on the other side.
Interest expense, what they pay for deposits and borrowings, actually went down by about $170,000 or 1.4% to $11.8 million. That reflects lower deposit costs.
So the yield on their loans ticked up.
Yep, by 8 basis points to 4.80%.
And the cost of their deposits went down.
By 13 basis points, down to 2.62%. So earning more, paying less. That's how you expand NIM.
That's the sweet spot. What's the risk to keeping that going? You mentioned the competitive market earlier.
That's the main headwind, especially on the deposit side. New Jersey is tough. They have to keep finding ways to fund loan growth without overpaying for deposits. That's the balancing act.
Right. And speaking of loan growth, they're clearly engineering the balance sheet, as you said. They originated $90 million in new loans this quarter.
At a weighted average yield around 7%. Pretty strong. Year to date, that's $180 million in new production.
Where's that growth coming from? Are they just chasing yield, or is it strategic?
It seems strategic. They mention organic growth in owner-occupied commercial real estate and construction. Those are core areas. But they also made some strategic purchases, about $45 million in credit-enhanced consumer loans and $19 million in residential loans.
Credit-enhanced. What does that mean usually?
It typically means there's some form of protection against losses, maybe insurance or guarantees, which lowers the risk profile compared to standard consumer loans.
Okay, so they're actively remixing the portfolio.
Definitely. C&I loans up, construction loans up. Interestingly, they let the multifamily portfolio shrink a bit by $37 million. Seems deliberate.
De-emphasizing certain areas.
Exactly. And the consumer loan book grew significantly by $76 million, largely from those purchases.
Is growing consumer loans riskier?
It can be, but management addressed this. They're comfortable taking consumer loans from about 5% now up to maybe 7-8% of the total portfolio. And crucially, they noted these specific purchase loans come with a 3% credit reserve already built in.
Ah, so some cushion there.
Right. Plus, they have a pipeline of over $40 million in signed deals, mostly commercial, expected to yield above 7%. So the momentum seems set to continue.
But again, funding all this. How are they managing that deposit side beyond just growing core deposits?
Well, that focus on full banking relationships is key. They want the whole relationship, not just the loan, to capture those low-cost operating accounts. But they're also being pragmatic. They used about $20 million in broker deposits this quarter.
Which can sometimes be seen negatively. More expensive, less stable.
It can be, but here they framed it as strategic use to manage upcoming maturities and smooth out the funding mix, apparently at attractive lower rates. So it's part of a broader toolkit, not just a desperate measure.
Multi-pronged approach then.
Makes sense.
What about the cost side of the equation, non-interest expenses?
They actually managed to trim those slightly, down about $90,000 from Q1. They seem to be holding the line in that mid to high $13 million range per quarter.
Pretty stable.
Yeah, though they did caution to expect a small bump in compensation costs in the second half, probably from higher variable pay as performance improves.
That makes sense. Are they finding efficiencies elsewhere?
They mentioned continuing to scrutinize all expenses and also looking at leveraging AI, like many banks are, to make staff more productive. It's about maintaining that cost discipline as they grow revenue.
Okay, let's pivot to shareholder value. Tangible book value per share went up again.
Yep. Up 6 cents to $14.87. That steady accretion is important.
And they're buying back stock too.
They are. They started their 6th repurchase program, authorizing buying back about 5% of outstanding shares, roughly 1.08 million shares.
And they were active in Q2.
Very active.
Oh.
Bought back over 406,000 shares at an average price of $9.42.
Which is quite a bit below that tangible book value of nearly $15.
Exactly. Management made a point of highlighting that discount. It's a clear signal they think the stock is undervalued and that buybacks are a good use of capital right now.
And they have the capacity to do this. Capital levels are strong.
Exceptionally strong. Their ratio of tangible equity to tangible assets is around 15.1%, which they noted is among the highest in the industry. That gives them a lot of flexibility for strategic moves and capital return.
So looking forward, management sounds optimistic, but they also guided to maybe limited expansion in the near term. Just a couple of basis points in the back half of 2025.
Right, a bit of a mixed message there, but it's about timing. They expect NIM improvement to be more muted in Q3 and Q4.
Why the pause after 3 quarters of gains?
It seems the bigger impact from loan repricing is further out. They specifically mentioned about $75 million in lower-yielding loans, currently around 3.75%, that are set to reprice in 2026. That's when they expect a more significant jump.
Ah, so the big wave hits in 2026.
That seems to be the expectation. There's a smaller batch, about $23 million at 4.75%, repricing in Q3 25, which will help a bit. But 2026 is the key period they're pointing to for substantial margin lift.
Okay, that clarifies the timeline. And they took a provision for credit losses. $463,000. Is that a worry?
Not really. They explained it was mostly related to reserves for loans they expect to fund soon, specifically unfunded commitments closing in Q3. It's more about accounting for future expected growth than current problems.
Okay. So that's the internal story.
Hmm.
How did the market react on earnings day? You said it was lukewarm.
Yeah, the stock actually dipped slightly, down about 1.36% to close at $8.70.
Even with the EPS beat and the NIM improvement?
Right. And it happened on pretty high trading volume, too, much higher than average.
So what did that tell us?
I think it reflects that cautiously constructive sentiment we talked about. The market sees the progress, acknowledges the narrower loss, but it's laser focused on the timing of getting back to sustained gap profitability. They want more certainty.
Even though the whole regional bank sector has been doing better lately?
Yeah, the KRE ETF, a benchmark for regionals, has been recovering, so the backdrop is improving. But Blue Foundry still has its specific story and hurdles, like that tough New Jersey deposit competition.
So the market is basically saying, great progress, but call us when you're consistently making money.
That sums it up pretty well, I think. The key catalyst everyone is watching for is that transition from narrowing losses to consistent profits. That's the next chapter.
Converting those margin gains into bottom line results.
That's the name of the game.
All right, let's shift gears to our not financial advice segment. And we really have to stress, this is just us exploring an idea, definitely not a recommendation. Talk to a professional.
Absolutely. Purely speculative discussion here.
Okay, so the setup is Blue Foundry is buying back stock way below tangible book. They've got tons of capital. Management seems focused on engineering higher yields and profits for 2026. But the market is still skeptical near term.
A disconnect between perceived fundamental progress and current market price, potentially.
So here's an well, maybe slightly outrageous, but potentially plausible trade idea for someone with a strong conviction and a longer time horizon.
Okay, let's hear it. Complex option strategy incoming.
You guessed it. We're thinking about a long-dated call spread with a protective put caller. It sounds complicated, but it's about structuring a bet on the long-term turnaround while managing the bumps along the way.
Betting on the transformation, but with built-in shock absorbers.
Exactly. So step one, you'd buy a long-dated, deep-in-the-money call option, maybe something like a January 2027 $5 strike call. Because the strike is well below the current price, it has a lot of intrinsic value already, and it gives you significant upside leverage if the stock appreciates towards, say, its tangible book value by 2027.
Capturing existing value and betting on future appreciation.
Okay. Step two, those deep-in-the-money calls are expensive. So to reduce the upfront cost, you'd simultaneously sell a higher strike call option with the same expiration. Let's say the January 2027 $10 strike call. This creates a call spread. Your maximum profit is capped at the difference between the strikes minus the net cost, but your initial outlay is much lower.
Okay, defining your maximum upside to finance the initial position, what about the downside protection?
That's the protective put collar part. Step three, to protect against unexpected drops or delays in profitability, you'd buy an out-of-the-money put option, but perhaps with a shorter duration, like a January 2026 $7 strike put. This acts as insurance, giving you the right to sell if the price falls significantly below $7 before early 2026.
Buying some insurance, that costs money too, though.
It does. So step four, to help pay for that put insurance, you sell another call option, even further out of the money, and maybe also with that shorter January 2026 expiration. For instance, selling the January 2026 $12 strike call. The premium collected from selling this call helps offset the cost of buying the $7 put.
So you're financing the put protection by selling away some potential upside above $12 in the medium term.
Precisely. Why is this outrageous but plausible? It directly plays on management's actions, buybacks below TBV, and strategy, asset remixing for 2026 profitability. It's a structured way to express a bullish long-term view while explicitly limiting downside risk and managing the cost, acknowledging the market's current skepticism about the exact timing.
It's definitely a high conviction play, leveraging options to define risk and reward based on that specific transformation story. Requires careful monitoring, for sure.
No doubt. It's a way to potentially ride out the journey to profitability without getting shaken out by near-term volatility. Again, not advice, just an idea structure. So let's wrap up this deep dive. Blue Foundry Bancorp. Q2 showed real operational progress, narrower loss, better than expected EPS, strong NIM expansion for the third quarter.
And clear strategic moves on the balance sheet, growing loans, remixing towards higher yields, focusing on core deposits, and managing expenses. plus strong capital return via buybacks.
But the market reaction was muted. Investors seem to acknowledge the improvements, but are waiting for consistent bottom-line profitability.
The outlook suggests near-term NIM expansion might be limited, but management is pointing towards 2026 as a key period for more significant improvement driven by loan repricing.
So the key takeaway for you, our listener, is that the bank is actively executing a multi-quarter pivot. The structural pieces seem to be falling into place, but the ultimate test will be converting that into sustained positive earnings. That's what the market wants to see.
Execution is everything from here.
Thank you for tuning in to the Deep Dive. Remember, this information is for educational purposes only, not financial advice. We welcome your feedback, and we'll be back soon with our next Deep Dive.